Good evening, everyone. I'm Derek Henry, Head of Tax for BDO Ireland, and you're very welcome to the BDO Budget 2025 podcast. We're just a few short hours after Minister of Finance Jack Chambers delivered his first budget. A very important budget for the government and the country, given it will be the last budget in advance of a general election. The economic backdrop to the budget is an economy at full employment, running significant surpluses with some windfall tax collections. And while they're all positives, at the same time, there is a housing and cost of living crisis that are putting individuals under real pressure. All the positives outlined give the government options and bandwidth. How the government order and prioritise these options could have a big impact on the shape and makeup of the next government. At a high level, what the Minister announced today was a budgetary package of €10 billion. This is smaller than the last two budgets. This is made up of permanent measures of 8.3, through spending measures of 6.9 and tax measures of 1.4 billion. Additionally, there'll be 2.4 billion of temporary measures to address the increase in cost of living. Offsetting this expenditure is that we're expected to have another record year of corporate tax receipts, which are expected to reach 27 to 28 billion. So what did we see in the details of Budget 2025? What issues have been addressed and what measures have we seen introduced or approved? And what opportunities have been missed? To help answer these questions and provide further overview and insight, I'm delighted to be joined by my fellow tax partners, Angela Fleming and Cian O'Sullivan. Angela heads up our financial services tax team, and Cian is a partner in our private clients team. Thank you both for joining us. Cian, I might throw it over to you first. It's always the popular topic, what it means for our pocket.
Yeah.
Minister Chambers indicated that everyone would be €1,000 better off through tax measures, and in addition to this there was going to be some cost of living measures. Has he achieved what he was going to say?
I think in the round, I think it's safe to say that has been achieved. It depends on the profile, but between cost of living measures and income tax cuts, to say that people would be €1,000 better off next year is fair to say, and for some others it'd be significantly more than that. So,
which is helpful coming into an election.
And back to the point, difficult for the government to get the balance right around helping people on the cost of living side of things, but not stoking inflation. There's a lot of commentary and warnings from IFAC and economists in the lead up to the budget, and in the immediate aftermath, the media response and feedback would seem to say that they didn't exactly get that balance right. But certainly from Joe Public's perspective, they'll be happy with this budget and they'll stand to have a lot more money in their back pocket next year. And maybe if I run through just the nuts and bolts
That'd be great, yeah.
on the personal tax measures and then the cost of living also, just how exactly that's going to work. So the thresholds have gone up 2,000 for anyone earning above €42,000. So if you're earning above 44,000 next year, that works at around €400 tax saving from what you would have paid this year. The USC rates have been reduced on the middle band from the 4% down to 1%. They've also tweaked the rate at which you come into the 3%. To account for the increase in the minimum wage. And then the main tax credits have gone up €125. Most people are able to claim two of these, that's €250. There's also been an additional increase in other tax credits, so I won't go down through each and every one of those, but all very welcomed changes. Minister Donoghue referenced that from 1 January 2021 to date, the cost of living has increased 19%. So to be fair to this government, they have made successive personal tax cuts in their time in government. But when you pit this against the cost of living increases, you'd still want to be doing well on wage inflation and wage increases to keep you where you were, or even be ahead. If where you were, you'd be doing well 3 years ago. So while this is all very welcome, I think you have to keep that in mind. People are still feeling that cost of living pinch. So these, some people might say that these are at a minimum measures that need to be introduced to get us back to where we would have been. On the cost of living side, big long list of measures. I'm not going to go through all of them in detail, but minimum wage going up 80 cent, social welfare payments up €12 per week. 9% VAT on residential gas and electricity extended to April 25. Energy credits, another €250. That's been rolled out again.
To every household.
Every household. Bumper child benefit payments in November and December, so €280 per child. They've tripled the child benefit payment for newborns. The National Childcare Scheme is up 44%. An October and Christmas social welfare bonus. So everyone's going to be very happy with these measures. They've announced a rake of additional supports for those in needs, which of course are very welcomed. And then on the property-related consumer side, mortgage interest relief has been extended by another year. This was introduced last year. It can be up to $1,250 in a tax saving for mortgage payers. So that will be good news for them. Help to Buy has been extended out to 2029, and the rent tax credit has gone up a further €250. People will be very happy to hear that that's been applied for 2024 as well as 2025. So there are some of the housing was obviously a key pillar of this budget. Some other measures that were introduced.
Yeah,
Derek?
as you say, it is the election topic, housing, and the government have to be very strong to be seen to be trying to address the issues, which in fairness they're making progress and have. I suppose taking a step back from housing for a second, I think what was very positive in this budget was the infrastructure measures that were brought in. The Minister announced that he's, in the first instance, creating a framework on which infrastructure decisions are made. It's not quite the Department of Infrastructure that some people were calling for, but it is a step in the right direction in terms of taking medium to long-term views, I suppose, in terms of how to spend windfall taxes on infrastructure. And that framework is going to come into effect on the 1st of our Q1 next year. But in the meantime, the Minister did announce a €3 billion package of infrastructure measures for housing, water and energy infrastructure, in particular with a focus on removing some of the bottlenecks for housing, which is key and very welcomed in terms of the delivery housing. How that $3 billion is split is $1 billion to Irish Water, $1.25 billion is going to the LDA. So this will give the LDA a total funding package of $6.25 billion, and that's to deliver social and affordable housing. And then EirGrid Infrastructure is getting an investment of $750 million into the infrastructure that closes off the $3 billion. Very welcomed given the growing population and some of the infrastructure deficits that we have.
Prudent planning there too for the future.
100%, yeah. I think it's good to see in a pre-election that they're thinking on that more longer term view. There's some other specific housing measures that were introduced. As you mentioned, the Help to Buy scheme, that the extension of that will give certainty both to the developer and the purchaser. So I think that's welcome. I suppose in an effort to try and incentivise landlords back into the market, pre-letting expenses, we'll say where you're renovating a property to bring it back on the market for rental, that relief has been extended, so that's helpful. On the residential zoned land tax, this was a point of discussion in the government before the budget, and they have introduced an exemption if you're carrying on economic activity on that, and you can demonstrate that genuine economic activity, which will help farming communities that are concerned that they'll have to start paying this tax on genuine farmland. Welcomed as well is a deferral for 12 months if you're a developer who have planning permission on the site but you're caught up in a judicial review process. We all know that's an issue for the market, so to have this deferral is very welcomed. The vacant homes tax, that's been increased by from 5 to 7 times the local property rates. So again, another measure to try and incentivise the underutilised properties being brought back into the market and being better utilised. I suppose both the residential zoned land tax and the vacant home tax is a penalty to try and incentivise in. We would have liked to seen some more carrots, so we were advocating for a 20% rate on the disposal of land that could be repurposed into residential, and it would have been nice to see. I think that would have been helpful to the supply. As anticipated, the stamp duty bulk buying, where you buy more than 10 properties in 1 year, that has been increased from 10% to 15%. It was argued in some aspects, or some elements of government were arguing for a 20% rate increase in that. So they got a middle ground on it, which is probably a fairer compromise. We would like to see in the finance bill a little bit of clarity around the definition of apartments which are exempt from that. That would be useful to give, again, developers some certainty in terms of their cost of development. This arrangement comes in with effect from tonight, the night of the budget, with some transitional measures for arrangements that are already underway. On the stamp duty side as well, there is a change in the residential for properties. What we have at the moment is two rates of stamp duty on private residential units. It's 1% on any property up to 1 million, and then 2% on any excess above 2 million. They've introduced a third rate, so the 2% rate now will apply from 1 million to 1.5 million. After that, a 6% rate, which is quite a big jump in stamp duty rates, will apply to any excess after that. So I suppose more generally, it's a bit disappointing to us that there aren't more incentive measures to increase supply. We would like to have seen a Section 23 or capital allowance scheme introduced in a very measured way that, you know, aligns with planning, that would help stimulate the market. That, along with you know, the replacement or the lower rate of tax to try and incentivise some of that land back into the property for residential development would be welcomed, but unfortunately it didn't happen.
Again, pre-election, probably giving incentives to landlords mightn't.
No, wouldn't curry favour maybe with the majority of the population, but we're in a crisis, and we feel you know, radical action is required to really stimulate the market. So some of those measures will have effects for some business, but there's some corporate tax measures that are interesting that have been brought in. Some probably go away, but we'd like further on some. So Angela, you might take us through what's been announced in the budget and where we are after the Minister's speech.
Sure. So look, the first piece of what is very welcome news now is confirmation today that we are getting a participation exemption regime on foreign dividends from the 1st of January. So look, we kind of knew that this was coming. We've had various feedback statements, straw man proposals, etc. over recent months and indeed years. But all the same, it is great to hear the confirmation today that that's definitely coming, and we'll see it in next week's finance bill. I think, you know, one of the biggest criticisms maybe of the last version of straw man that we saw was the narrow geographical scope of it. So it's going to be limited to dividends that are being paid up from subsidiaries either in EU jurisdictions or treaty jurisdictions. I think generally the view was we would like to see it on a worldwide basis. I don't think that's going to change, but there was some indications in the speech there today that they're open to that and they'll keep that under review. And I think that's positive and wise as the international tax landscape continues to evolve.
We need to be competitive within that.
Absolutely. I think, you know, something we are not yet going to see, had kind of maybe hoped to, we spoke about this last year as well, the fund sector review that's been ongoing. Last year we hoped to see some changes, we didn't, and it looks like we're going to have to wait a little bit longer. So the Minister said that report will be published shortly, so that will kind of indicate to me not to expect too much in the finance bill next week, unfortunately. But we'll watch this space. Another area that's been under review is the whole area of deductibility rules for interest. So there was a public consultation paper launched just last week actually on this. So that's good to see, I suppose, some progress being made in that area. Probably like that to come a bit sooner, but at least we're on the track now.
Yeah, there's a number of areas that need simplification. That's the big one.
That's the big one. That's the big one. last year, we saw a massive increase in the yield from the bank levy. So that is here to stay. The bank levy is being extended for another year, and is staying at that big yield of 200 million, which is significant, considering we only have a small number of banks that actually have to pay it. On the R&D tax credit side, so another area that we're going to see a review in. So the Minister mentioned today that regime is going to be reviewed over the coming year. But in the meantime, we have actually had a positive change on that. So for kind of maybe smaller startup companies that are claiming it for the first time, there's going to be an increase in the claim threshold for them for the first year from 50 up to 75k. So that's a really welcome cash flow measure for companies claiming that.
I think this is about the third review that's been done of the R&D credit, so hopefully it's positive, because it's very important for both Indigenous and multinationals relief.
Absolutely. And then the last point I want to comment on, I suppose we've seen some pretty high profile exits from Euronext Dublin over the last 18 months. And it has raised some questions about the future of the Irish Stock Exchange. So there was two interesting comments there today. So the first is the introduction of relief for if a company incurs up to $1 million of costs in kind of preparing themselves for their first listing. So they're now going to be able to get a tax deduction for that. So that's really positive. And the other thing that's being looked at is a stamp duty exemption. So hopefully we see some movement on that in the short term. Look, I think there's probably lots more that can be done to encourage a active and thriving Irish equity market. But look, there are some really good first steps, is what I would say. Cian, you wanted to talk about some measures that are more kind of relevant in the SME space?
Yeah, sure. And again, every year it's a consistent call for widening reliefs, measures to help SMEs attract and retain talent, access to funding, and dealing with the cost of living measures. There's a lot of measures announced. The impact they'll have are probably questionable. Very small tweaks here and there, it would seem. If we run down through them very quickly, the small benefit exemption that employers can give to employees, that was €1,000 a year, but it was capped at 2 gifts a year. So even if you gave a gift of 100 in January, another 100 in February, was it. You were done. You were finished. They've increased that to 5 gifts and also to 1,500. So that'll be welcomed.
Flexibility in there.
Bit of flexibility. I don't know why they kept it at 5. Just removed that altogether. It's an administrative burden for employers to try and keep track of all of that. If you get someone a bouquet of flowers for a birthday or something, technically that's a gift. So that's one strike. The CGT retirement relief. This is a hot topic following last year's budget. And in the lead up to this budget, there's been a lot of calls for the changes that were announced last year to come effective 1 January 2025 to be revisited. It would seem they have been revisited. There was a cap introduced, a €10 million cap, whereby retirement relief would cease to apply for anything above that between certain ages. They seem to have they seem to be intending to replace that with a clawback for any disposals within 12 years, with a cap of 12 million at that on the disposals. So that would be a welcome change. Obviously, the devil be in the detail here, and we'll see when the finance bill is issued next week. But definitely something that business owners and family businesses will see as a very positive step. The CGT angel investor, it's a special 16% rate of CGT on certain disposals. Again, great in theory, but in practice, are a lot of restrictive qualifying conditions. And one of them is that you have to get revenue certification, and anyone dealing with high growth startups, having this as a priority and going through that heavy administrative process is a tall ask.
It can be difficult to get if you have the time to get it.
If you have the time, and they've changed it, but the change they've made is increasing the lifetime limit from 3 to 10. So it hasn't really widened the access to the relief. BIKs or BIK and electric motor vehicles, that exemption is being tapered out in 2025. So there was a 10,000 euro relief on the tapering out of that announced last year that have extended that to 2025. Auto enrollment is being legislated for. That's going to kick in now in September 2025. So this is an increased cost for businesses. Startup relief from CT, something that applies for new businesses. The first 5 years they can get a relief or an exemption from CT corporation tax subject to qualifying conditions. They've widened that to include Class S contributions, so the relief is linked to the amount of PRSI you pay. So they've included Class S contributions, but only up to 1,000.
So that'd be for self-employed people.
So that'd be self-employed people. They'd include some of the PRSI they pay, but again, it's not gonna move the needle massively on this relief. EIAS, SURE, startup capital incentive, all designed to help introduce finance into SMEs. That's been extended for 2 years. And then on the agri sector, there was a couple of notable announcements which I might cover off. At this stage, it almost seems the annual extension of the Young Trained Farmer and the stock reliefs. So that's been extended again,
Which is welcome.
which is very welcomed. And then on CAT agricultural relief, which is a very important relief on the transfer of agricultural property from one generation to the next. That has been so the disponer or the person giving the gift now needs to satisfy a 6-year active farmer test, whereas previously it was the person who was receiving the gift or the inheritance who had to satisfy that condition. And this is to guard against agricultural relief being used as a tax planning tool, increasing agricultural prices.
The devil in the detail is going to be important on that one.
Certainly.
Because obviously you could have a retired farmer a couple of years and just see how that would impact it. So you don't want any unintended consequences, I suppose, in that anti-avoidance. And some VAT measures around agri.
So VAT measures on agri, Angela, you want to talk
Yeah.
to that?
Yeah, so last year we saw a reduction in the flat rate scheme for farmers. That's going back up now to 5.1% from the 1st of January. Some other VAT measures we saw in the budget, Cian, you mentioned already, as part of the cost of living package, an extension of that reduced 9% rate for gas and electricity out to April. And look, that's, this is the time of year that's needed when the gas and electricity bills are the highest over those winter months. So that will be very welcome. Yeah. The VAT registration thresholds. So last year there was an increase in those thresholds and they hadn't been increased for quite some time. So they're getting increased again this year. So they're now going to be 85,000 for goods and 42,500 for services. So that's the threshold at which a trader has to register for VAT. And then finally, and I suppose as part of the government's kind of overall attempt to encourage homeowners to kind of retrofit their homes and bring them up to spec, is a reduction in the VAT rate on heat pumps from the current standard rate of 23% down to 9%. So that will be pretty welcome in reducing the cost of retrofitting.
But yeah, and Minister Donoghue announced a raft of grants that are available to retrofit your house as well. So again, on that agenda of both the carbon side, but also reducing the cost of living through energy saving. Thank you very much for that. I suppose, any last comments or observations? Angela, I might throw it over to you first. Sure. In terms of your overall impression of the budget and how well our new Minister of Finance has done.
So, look, I think I'll echo the sentiments from last year. There's still opportunities for us to simplify our tax code and reduce the admin burden for taxpayers, which has just grown exponentially over recent years. We've seen loads of really complex international tax law getting kind of dropped into our existing legislation. And while it's right and appropriate that we play our part with international tax reform. It's, you know, also very important that we remain competitive internationally.
Yeah.
So any kind of opportunities that there are within the tax code to simplify either the legislation itself or the administration of it, I think should be grasped with both hands. So there's definitely some more work to do there. I think, you know, various reviews are getting it on that path, but progress could be quicker, I think.
Positive outcomes from them would be great. Cian, I'll throw it over to you for any observations.
The first observation I make is on the sports side. So there's some welcome measures there. First is a technical adjustment, which will be forthcoming for the sporting exemption, the income tax and CT exemption that's available for approved sporting bodies, which should copper fasten relief where reserves are being built up for capital expenditure, whereas previously the wording of the legislation didn't technically quite cater for that. There was 231 million in expenditure announced by Pascal Donoghue for sporting bodies next year, which, riding the quest of the wave on recent sporting successes, I think is only right and fit. And then thirdly, donations to sporting bodies. Currently, the way the relief is administered is a bit inconsistent. Companies and self-assessed taxpayers, they get the benefit of the tax relief, whereas POAE taxpayers, the sporting body gets the benefit of the tax relief. Minister Chambers announced that he'll be baking in some flexibility as around to who decides how that tax relief is allocated, which should hopefully increase donations in this space, which again is very welcomed. So that's on the sports side. Opportunities missed. I think it was the same last year. The 3% USC for self-employed still hasn't been changed. This was flagged and is consistently flagged. It was flagged in its tax strategy group papers. The Commission on Taxation and Welfare have also flagged it. It's inequitable and it's stifling entrepreneurship. So probably wouldn't have been very popular with the pre-election hat on, so maybe that's why it wasn't introduced. And then lastly, SMEs, you know, went through the measures there. You'd query how impactful those are going to be. You look at auto enrollment, the increase in minimum wage, the PRSI changes over the next 5 years, a 0.7% increase is, you know, there's a 1.1% increase effective today. Yeah. So that's going to hit hard on SMEs. And, the measures announced today, will they go far enough to help them tackle that cost of living pressure, retaining talent and getting much needed investment?
Probably don't think that they will. There could have been more done. I suppose maybe to end on a positive, I would very much look at the infrastructure funds and how they're trying to take a medium to long-term view on that. I think it's very positive that they're going to build a framework in terms of how to deliver that infrastructure. We know we've got an infrastructure deficit, and I suppose it's good that even in a pre-election year that the government are committed to doing something like that. So I suppose that I'll wrap up on a positive note with that. I'd like to thank you both for your contribution. Thank you for your insights. That was very good. I suppose, as you've heard, a lot to digest and interpret. As always is the case on Budget Day, the details of the various schemes and measures will become clearer when the Finance Bill is published, which we expect to be the 10th of October, so quite a quick turnaround. We have an early budget and we're expecting early legislation on it as well. Please keep an eye out, as BDO will be providing updates on the Finance Bill as the details emerge. In the meantime, I would like to thank you for your attention to the podcast. We hope you found it informative. At BDO, we support the business community in Ireland, and we hope that elements of the budget have had a positive effect on your business. Please do reach out if there's anything that you would like to further discuss on Budget 2025 or any other aspects that we can help you with. We look forward to hearing from you in the future, and thank you for your attention.